under IFRS 9, we say that financial instrument is a contract which gives rise to a financial asset to one of the entity and a financial liability or equity to another entity. So therefore, financial instrument is a contract which give rise to financial assets to one entity and a financial liability or equity to another entity. So that is the definition of a financial instrument in accordance with the International Financial Reporting Standard number 9. So let me give a small illustration here so that you can be able to understand this particular definition. Assuming we have a company here that is a company X, and this company wants to raise capital. We are saying this company can raise capital either by issuing shares or maybe by issuing debt instrument, like this company can issue debentures. And we assume that some of the debentures issued by our company here, some of them will be issued to company Y. So in this case, we say that these two companies here, they have entered into a contract, or we have a contract entered into between these two companies for the issue of shares, or basically for the issue of what? Of debentures. And generally what we know is that if, for instance, this company issues shares, and specifically we assume that the shares which have been issued by this company are ordinary shares, then this company will raise a capital, which is known as ordinary share capital. And we know that ordinary share capital is a part of equity. It's part of what? Equity, because equity comprises of what? Share capital and reserves. So therefore, you can see that as a result of this company issuing shares, specifically ordinary shares, then that gives rise to equity. On the other hand, let's assume that this company here, that is company X, equally has issued debentures. Once a company issued debentures, this company has an obligation to pay interest plus the principal amount, because these debentures, we can be told, for example, they have a life of 5 years. So if they have a life of 5 years, it means that this company has an obligation to pay interest for the next 5 years. And then at the end of the 5th year, the company has to redeem these debentures by refunding the principal amount, which was invested by who? Which was invested by the debenture holders in the company. So therefore, this company here has an obligation to pay interest and the principal amount, and actually that obligation to pay cash. If you have an obligation to pay cash, then this is a liability. This is what? A liability, because by definition, we say that a liability is a financial obligation to pay. So therefore, you can see that as a result of this company issuing debentures, then you can see that is a form of a liability. And specifically, that one we refer to it as a financial liability. As a result of the company issuing shares, that give rise to what? To equity. Now, on the other hand, this particular company here, our company Y, will invest. Will invest in shares, will invest in debentures, which are issued by company what? X. So means that this company has invested. So basically, we know that an investment to you, even as a person, an investment to you, even as a person, is an asset. If you invest in shares, you invest in debentures and so on, that is an asset, but specifically we refer to that as a financial asset. So therefore, you can see that this company, as a result of having invested in shares or debentures issued by a company X, then that gives rise to financial what? Asset. That's why we are saying that a financial instrument basically is a contract, which, for example, will be entered into between these two companies. It gives rise to financial asset to this company and give rise to financial liability to this company, all equity to this what? To this company. That is the definition of a financial what? Instrument. And then on the other hand, there are equally some few terms you also hear to be in a position to define. For example, you must be in a position to define the word financial asset. Financial asset here, where this in very simple terms, we have said is investment in shares, investment in debentures, but by definition of a financial asset, or in terms of how we define a financial asset, we say it is basically a contractual right, like a contractual right to receive what? Cash, which may be in form of dividends, which may be in form of what? Interest. On the other hand, when we talk about a financial liability, there is something we have mentioned here. It is basically a contractual obligation to pay cash by a company as a result of issuing debentures, as a result of issuing what refers the shares and so on. Then from there, next we can look on the recognition. But generally, before we look on the other concept here, it's important to note that IFRS 9 basically prescribes how these particular financial instruments should be recognized in the financial statement, should be measured, how their value should be what should be determined, and also how are they supposed to be presented in the financial statements of the company. So that is the what IFRS 9 International Financial Reporting Standards prescribes, which basically is a standard which was issued by International Accounting Standard Board to replace the old standard on financial instruments. Previously, financial instruments were recognized or basically were accounted for in accordance with these particular standards, IAS 39. If you go to some questions which were tested some time back, you'll see those questions quoting IAS 39. That standard has been scrapped. It has been done away with and replaced by what? IFRS 9. So meaning that currently financial instruments are recognized, measured, and also presented in the financial statement in accordance with what? In accordance with IFRS what? IFRS 9. So next year we can look on something to do with recognition and de-recognition of financial instruments in accordance with the IFRS 9. So maybe first of all, we can start by looking on the recognition of financial instrument. So when talk about recognizing something, recognizing an asset, recognizing a liability, basically this is a process through which an asset or a liability is recorded in the company's books of account and also in the financial statement. So therefore, recognition of financial instruments, we are talking of the process through which an entity should recognize financial instruments in its financial statements and also the books of accounts. So according to IFRS 9, International Financial Reporting Standard number 9, financial instruments are supposed to be recognized or should be recorded in the company's books of account when an entity becomes a party to contractual relationship. When the company or when an entity becomes a party to the contractual relationship, what does that mean? It means that once this company issue, for example, shares and debentures, the company has already become a party to that contract. So if company X issues shares or debentures to company Y, this company has become a party to that contract, even if company X has not received the cash, or basically has not been paid for those shares or debentures. It has already become a party to that contract. So it should go ahead and do what? Recognize those particular debentures or shares in its books of accounts. The same case, once this company has purchased some these shares or debentures issued by company X, then this company, even if it has not paid for those shares or debentures, the company has become a party to that what? Contract. According to IFRS 9, this company should proceed and do what? Recognize those financial instruments in its books of what? Of accounts. So that is the criteria for recognizing financial instrument in the company's books of accounts. So then from there we have the recognition of financial instruments. So when talk about the recognition of financial instruments, this is now the direct opposite of recognition. The recognition is the process of removing a previously recognized financial instrument from the entity's statement of financial position. So this is the removal. the removal of previously recognized financial instruments from entities' statement of financial position. The process of what? Removing a previously recognized financial instrument from the entity's books of what? Of accounts. That would refer to the recognized. Now, IFRS 9 has actually given the criteria for the recognizing financial instruments, and those criteria are classified into two. We can talk first of all the criteria to recognize a financial asset. What are the criteria for recognizing a financial asset? And in this case, when we talk about the financial asset, which should come into your mind very fast, is that here we are talking of investment in shares. We are talking of investment in debt instrument. Once you have invested in shares, once you have invested in debt instrument, what is that to you? Is a form of financial asset. So therefore, that's what you should remember very fast. Anytime you hear the word what? Financial asset. Once company Y has invested in shares or debentures, then that is a financial asset. So which are the criteria for the recognizing financial assets? At the IFRS 9, we have two criteria. One is when an entity transfers the risks and rewards which are associated with financial assets. When the entity transfers the risks and rewards associated with the financial asset. So what do you mean by transferring risk and rewards? In very simple terms, this where a company, for example, this company has invested in shares or debentures of company X, but this company has transferred the risk and rewards. Transferring risk and rewards means that this company has sold, for example, those shares, and maybe those shares are sold to company A. So once a company sells shares, it has transferred the risks and rewards associated with that investment to company what? A. So it obviously means that this company will not continue accounting for that asset in its statement of financial position. That company has to be recognized. Has to do what? To remove that investment, which is recognized as an asset in its statement of financial what? Position. It has to be recognized because the company has done what? Has sold. So that is the first criteria. So therefore, in very simple terms, when we talk about transferring the risk and rewards, this is all about selling financial assets. This is all about selling the financial what? Assets. Selling the financial assets. And then we have the other criteria number two. The other criteria number two for the recognizing financial asset, and that is when entities right to receive. When the entity's right to receive cash expires. When the entity's right to receive cash has done what? Has expired. So what basically do we mean by this? What do you mean by this? Let me explain this in, for example, a very practical example. As an individual, you have invested in treasury bonds. You have invested in treasury bonds. I hope you know what are treasury bonds. Patricia, do you know what are treasury bonds? Yes, do you know what are treasury bonds? Treasury bonds, yes. So treasury bonds, basically these are the debt instruments which are issued by the government anytime the government is borrowing money locally. So like in this case, I think like, was it yesterday or the other day, I saw the government issued some treasury bonds, some having a life of 2 years, some having a life of 3 years, and so on. Let's assume that in this case, you have invested in a treasury bonds having a life of 2 years. It means that in the next 2 years, you're going to earn interest. You're going to receive interest, though we know that the interest for this treasury bonds is paid semi-annually after every 6 months. You're going to earn interest for the next 2 years. And then at the end of the second year, you'll be given back the principal amount which you invested. So if you had invested 1 million, you're going to be given back your 1 million. So it basically means that as a result of having invested in this treasury bonds, which basically we are saying to you is a form of financial asset, then at the end of the second year, your right to receive cash, here will do what? Will expire. So it means that if you're a company, then there is no way you're going to continue, you will continue showing that as a financial asset, because your right to receive cash has already done what? Expired. You have been given back your 1 million. So then there is no way you can continue saying that you have a financial asset, which is investment in treasury bonds. You have already been given back your money. So therefore, these are the two criteria for the recognizing financial asset. When the entity transfers the risks and rewards associated with the financial asset, and when the entity's right to do what? To receive cash has done what? Has expired. Then from here we can look on the criteria for the recognizing financial liability. Criteria for the recognizing financial liability. What is a financial liability? When we talk about the financial liability, equally what should come into your mind very fast is that we are talking of the debt securities which are issued by the company. For example, a company issue debentures, a company issue bonds, a company issue loan stock. So these to the company are liabilities. Specifically, they are financial liabilities. So here we have one criteria for recognizing this, one criteria for recognizing this, criteria for recognizing financial liability, and that is when all financial liability should be recognized when the entity obligation to pay, when the entity obligation to pay cash expires. When the entity's obligation to pay cash do what? Expires. The entity's obligation to pay cash has done what? Has expired. So like in this case, assuming you have a company, that company has issued debentures having a life of 3 years. So if the company issued debentures, and those debentures, they have a life of 3 years, it means that the company is supposed to pay interest for the next 3 years. And then at the end of the 3rd year, the company will have to redeem these debentures because they will mature. At the end of the 3rd year, the company will be required to redeem them by paying back the principal amount. So basically what that means is that at the end of the 3rd year here, we say that the entity's obligation to do what? To pay cash. Entity's obligation to pay cash has done what? Has expired. It is obvious that the company will not continue showing those particular debentures as a liability in the statement of financial position. So therefore we have, that is the only criteria upon which a financial liability is supposed to be what? Is supposed to be recognized. It's supposed to be what? Be recognized. So that is something which is very, very important. You need to know, because you may come across a question here whereby you are required to do what? Whereby you are required to explain the criteria for recognizing, and also the criteria for recognizing both financial assets and also the financial liabilities. So yes, so that is it. So next, I want us to look on something else here. Specifically, I want us to look on something called the compound financial instruments. Compound financial instruments, popularly abbreviated or popularly known as CFI. Compound financial instrument. So what do you mean by compound financial instrument? Compound financial instruments. So these are those particular financial instruments, e.g. debentures, e.g. bonds, which contains both equity and liability components. So therefore, CFI, we are saying that these are financial instruments. These are financial instruments which contains both equity and liability component, which contains both equity and liability component. Equity and liability what? Component. So what are good examples of this? Examples include convertible securities. Examples include convertible securities or the convertible financial instrument. The convertible financial instrument, e.g. what? E.g. the convertible loan stocks, e.g. the convertible debentures, e.g. the convertible bonds, etc. So anytime you see the word convertible, then that is a good example of a compound financial instrument. And actually, we are saying that this particular compound financial instrument, they contain both equity and liability components. So why do we say that they contain both equity and liability component? Is because this particular financial or this particular convertible securities, number one, they confer. To confer means that they give the holders an option. They confer the holders an option to convert them into ordinary shares. And basically this right to receive, or basically to convert these convertible securities into ordinary shares, this itself is known as equity. So because equity is like the right to receive ordinary shares of the company, if you have the right to receive the ordinary shares of the company, that is itself is an equity. So therefore, that's why number one, we are saying that they contain equity component. They confer, they give the holders an option to convert them into ordinary shares of the company. And number two, we say that they impose an obligation. They impose an obligation to the issuer to pay cash. They impose an obligation to the issuer to pay cash. Once a company has issued convertible loan stock, convertible debentures, then this company has an obligation to pay cash, which is in form of interest and also in form of principal amount. Because I've said that if a company issue, for example, debentures or convertible debentures having a life of 3 years, it means that this company has to pay interest for the next 3 years, and then at the end of the third year, the company has to pay back the principal amount. The company has an obligation to pay what? Cash. Has an obligation to pay cash in form of interest, in form of a principal amount, which means that this obligation to pay cash, this itself is a liability. This itself is what? Is a liability, because by definition, you have said that a liability is an obligation to pay cash. Is an obligation to do what? To pay cash. So therefore, a compound financial instrument CFI are those particular financial instruments which contains both equity and liability what? Component, which contains both equity and liability component. And actually, in this case, we are saying good examples of this are basically what? The compound financial what? The compound financial we're saying the good examples of a compound financial instrument are the convertible securities. Now, once a company has issued these compound financial instruments, a company is required by IAS 32, International Accounting Standard Number 32, to split the two components, that is the equity component and the liability component, and account for them separately. And account for them what? Separately. So therefore, IAS 32 requires an entity to split the two what? The two component. Requires an entity to split the two component. Which are which two components are we talking about? We are talking about the equity and the liability component. Equity and liability component. The company should split these two what? Components. Should split those two components. So how should this split be done? So how should the company split the equity and liability component. So there are two steps which should be followed, or basically which are followed by an entity splitting the two components. Step one involves computation of liability components. Step one, an entity should compute the liability component. Step one, compute the liability component. The liability component. What is the liability component? You have to recall what we have said here. We have said the liability is the obligation of the company to pay cash. So the cash which is to be paid by the company is the interest and the principal amount. Interest and the principal amount. Interest and the principal amount. So basically what that means is that if, for example, we are told the company has issued like what? A company has issued debentures. And those debentures, they have a life of 3 years. Then we are saying that company at the end of year 1, at the end of year 2, at the end of year 3, the company has to pay interest. And then at the end of the 3rd year, because those debentures have matured, the company has to pay back the principal amount. So therefore, to determine this liability, because we are saying it's that obligation to pay cash, what we do is that we discount this amount here to be paid by the company, including the principal amount. So means that the liability component is equal to the present value of the annual interest. This interest to be paid by the company, have to discount it. And then to this, we also add the present value of the principal amount. That's how we get the liability component, by discounting those particular amount to be paid by the company, which are either interest, or which are both interest and the principal amount. So in step number 2, step 2 entails computing the equity component. Step 2, compute the equity. We compute the equity component. So how do we compute this equity component? We compute the equity component by taking the total proceeds. Total proceeds, in other terms, is the cash received, is the amount received by the company. Amount received. So how much amount was received by the company from issuing this compound financial instrument? Amount received, and then to this we less the liability component, which was computed in step 1, Whatever you get here is now the equity component. Whatever you get here is the equity component. And this particular equity component, which we get here, I can see you can't be able to see down there. Let me adjust my camera slightly. Yes, so whatever you get down here, this one is known as what? The equity component. The equity component. Actually, this equity component, the value for this equity component remain constant. This one will not change in year 1, year 2, year 3, year 4. It will not change. It remains the same. But this one, whatever you have determined in step 1, liability, because now that represents what the company will pay in year 1, year 2, year 3, this is like a loan to the company. This is like a loan to the company. Therefore, this liability, this one has to be amortized. Just like the way we amortize our own. Just the way we amortize what? We amortize our own. Sasa? Yes. So basically, this is how an entity should split the equity component and also the liability component as far as the compound financial instrument are what? Are concerned. So I hope we are together up to that particular point. Are we together? Are we together up to that point, Rogers? Patricia? Ken, are we together up to that point? Are we together up to that point? Okay. So I think with that particular knowledge, I want us to illustrate how we do this, because there is a question from the past papers. There's a question, you may come across a question on this. And before we look on any other concept, can we look on this? We look on an illustration as far as this is concerned here. There is a small question which is here, which is not just a small question. So the questions you're likely to come across from this topic are questions not carrying so many marks, but question may be carrying 6 marks, 8 marks, 10 marks, not a question for full 20 marks. We have a question here for May 2021. May 2021. Question 4B. Question 4B. I hope you have the past papers with you. Yes, do you have the past papers? Do you have those past papers? Patricia? Rogers, Ken, do you have these past papers? Yes, so if you have those past papers, then go to this question here. Question 4. Question 4B. Question 4B. Question 4B of May 2021. Of May 2021. Yes, someone sent to share this, the question maybe in the WhatsApp group. Yes, someone to share. Once you get that question, let me know, Rogers. Once you get the question, let me know so that we can be able to proceed. Okay, so let's go through then that particular question. We see what we are told. So the question reads basically a small question of 6 marks. It reads 𝗨𝗏 Limited issued 500 convertible roll notes on 1st January 2018. At par. Each roll note is redeemable in 3 years' time. In 3 years' time, at its par value of shillings 2,000 per roll note. Alternatively, each note can be converted at maturity date on 1st of January 2021 into 125 shillings 10 ordinary shares. And then you're told the roll notes pay interest annually in arrears at a coupon interest rate based on the nominal value of 6%. And then you're told the prevailing market interest rate for 3 years roll notes without conversion rate is 9%. So what are we required to do? We're required to prepare extract of financial statements of 𝗨𝗏 Limited for each of the year which ended 31st of December 2018, 2019, and 2020. So basically what we are required to do here is we are required to prepare financial statement extract. But even before we do that, it is important here to note that this company, that is 𝗨𝗏 Limited, we are told it issued 500 convertible roll notes. Convertible roll notes. Anytime you say the word convertible roll notes, what you need to remember very fast is that this is a compound financial instrument because these are convertible. But if it was not convertible, it can't be a compound financial instrument. So therefore, this convertible roll notes, which were issued by our company here, which is 𝗨𝗏, this is what? A compound financial instrument. And actually what you have said is that according to International Accounting Standard number 32, anytime a company issue a compound financial instrument, the company must treat the 2 components, the equity component and the liability component. And the liability component, we have said it has to be amortized. So whenever we are amortizing a liability, we have an interest component which should be recognized as an expense in the income statement. And also we have the liability component at the end of the year, which should be recognized in the statement of financial position as what? As a liability. And then from there, we will also determine the equity component, whose value we have said remain what? A constant. So therefore, we have said that in splitting the two components, equity component and the liability component, I've said we follow two steps. Step one, we compute the equity liability component. Step two, we compute the equity component. So therefore, the first thing we need to do here is to determine the liability component on the date of the issue. So when were these convertible notes issued? They were issued on 1st of January 2018. That is when we need to split. We need to split our two components here. We need to split our two what? Our two component. Yes. So, and remember, we have said that to split this, or to compute this, I've said we take the present value of annual interest plus the present value of the principal amount. The principal amount. Present value of annual interest plus present value of the principal amount. So therefore, those are the two values we need to determine here. We need to determine the interest to be paid by this company on annual basis and the principal amount, and then we discount them. We get their present value. So let's determine annual interest first of all, and then the principal amount, and then we discount the two items. So we start with annual interest. So how do we compute the annual interest? The interest to be paid. This is a formula which we use here. You have to remember this. So first of all, we take the coupon rate times the par, is also known as the nominal, is also known as the face value of the CFI. Remember, this convertible loan stock we have said is a CFI. So therefore, this is how we compute the interest to be paid by the company on annual basis. The coupon rate times what? The par, the nominal, or the face what? Value. So if we go back to the question, to this question, you'll be able to see we have two rates. We have two rates. In the last, actually in the last paragraph, paragraph 2, we are told the loan note pay interest annually in arrears. In arrears means that the interest is supposed to be paid at the end of each year, at the end of the year. In arrears, at a coupon rate based on the nominal value of 6%. So means that the coupon rate in our case here, the coupon rate is what? Is 6%. That is the rate which we use to compute the interest to be paid by our company on annual basis. And then we multiply that with the nominal, the face, or the par value of the compound financial instrument. So if we go back to this particular question here, in the first paragraph, can you go back to the first paragraph? In the first paragraph, we are told Naivasha Limited issued 500 convertible notes on 1st January 2018 at par. And then we are told that each loan note is redeemable in 3 years' time at its par value of 2,000 per note. So basically what that means is that this company, as per that information given in paragraph 1, it issued 500 convertible loan notes. And then in sentence 2, we are given the par value for each loan note. The par value for each loan note is 2,000. That is the par value, which I'm saying can also be referred to as the nominal value, which can also be referred to as what? The face value. The examiner can use any of the words here. So this is how we compute the interest this company should pay on annual basis. So this will give us a figure of what? This will give us a figure of what? Once you get the answer, type it in the chat box. I'll be able to see it down there. This will give us a value of how much? This will give us a value of how much? This will give us a figure of what? 6% of 500 times 2,000 Yes, what are you getting? What are you getting? Yes, Patricia, Ken Rogers, I'm waiting for your answers here. I'm waiting for the answer. Yes, I'm told this will be sharing 60,000. Sharing 60,000, and this is the interest per annum. This is the interest per annum. And then from there, we determine the principal amount. What is the principal amount? The principal amount, this is the amount to be paid on the redemption. Once this convertible notes matures, how much amount will the company pay back to the investors? That is now what we refer as the principal amount. And in this case, the principal amount, the amount to be paid on redemption, this one is always equal to the par value, unless otherwise stated. Unless otherwise stated. Unless otherwise what? Stated. Unless otherwise stated. So basically what that means that if the question is silent, the examiner has not even given you any information about the amount to be paid on redemption, that should always be equal to the par value, which is also the same with the nominal or the face value. But there are some instances whereby you can be told by the examiner that you can be given the amount to be paid on redemption. For example, in this case, you can be told that the company will redeem this particular convertible notes maybe at 2.5 million. 2.5 what? Million. So that is now what you use as your principal amount, as a principal amount. But like in this question, I think we are told specifically the amount to be paid on redemption. Let's go back to paragraph 1, specifically sentence 2. And you're told each row note is redeemable. I hope you can see that. Paragraph 1, sentence 2. Each row note is redeemable in 3 years' time at its par value. At its par value. So mean that the amount to be paid on redemption is equal to the par value. And therefore, the total amount to be paid on redemption will be equal to the convertible notes which were issued 500 times the par value for each. The par value for each. I think this will give us shillings 1 million. Shillings 1 what? Million. And therefore, this company which has issued this particular convertible row notes, and actually I hope you can also see in that paragraph, there is not a paragraph rather, in paragraph 1, sentence 2, we are told each row note is redeemable in 3 years' time. In 3 years' time. It basically means that these convertible row notes, they have a life of 3 years. A life of 3 years. 3 years. Year 1, year 2, year 3. It basically means that this company here, at the end of year 1, our company has to pay this interest, 60,000. In year 2, the company will pay 60,000. And also in year 3, the company will pay an interest of 60,000. And also at the end of the 3rd year here, the company has to redeem those convertible notes by paying back the principal amount of what? 1 million. So therefore, to determine the liability component, we are saying we discount all this. That's why we are talking of getting the present value of the annual interest. You just need to discount this. And then plus the present value of this principal amount. So basically what now we need to do here, we apply the concept of discounting. So how do we discount this? You may decide to use the formula, or we can just prepare a table here. Let's just prepare a table. And then can we have the specific dates, or let's just talk of years, because we have year 1, year 2, year 3, year 1, year 2, year 3. Yes, we have year 1, year 2, year 3. Yes. And then this amount to be paid by the company, can we refer to them as cash flows? Yes. Let's just refer to them as cash flows. So in the first year, the company will pay 60,000 from what we have here. 60,000. In year 2, the company will pay 60,000. So who can tell us how much amount will be paid by the company in the 3rd year? Rogers, Patricia, how much amount will be paid in year 3? In year 3, in the 3rd year, the company will pay amount of how much from what we have there? This company will pay how much in the 3rd year there? Yes, our company will pay 10. Will pay 10, 60. That is the amount to be paid. The interest plus 1 million. So then what we need to do, because we need to discount this, we need to multiply that with the present value interest factor. And which rate do we use in terms of discounting this? So if we go back to paragraph 2, the last sentence we are told the prevailing market interest rate for 3-year convertible loan note without conversion option is 9%. So always for discounting purpose, the examiner will give you a rate which is called the market interest rate, or he can also refer to that as effective interest rate. That is the rate which you use for discounting, because I hope you can see here, we have 2 rates. We have this coupon rate. That is not the rate you use for discounting. You use the market interest rate or the effective interest rate, which in our case is what? Is 9%. So we need to get the present value interest factor at the rate of what? 9%. 9%. And then once we multiply these two, we will get the present value. So can we get this? And you have now to remember the formula, because in financial reporting paper, the examiner will not give you those tables for getting the present value interest factors. You'll not be given those tables. You have to remember the formula. So the formula for getting this is 1 plus R raised to power negative what? N, raised to power negative N. Yes, give me the figure for the first year. In the first year, we will have 1.09, 1.09. We raise that to power negative 1, to power negative 1, to power negative 1. So I'm getting this one, 91.74. And it's obvious that you have to give me that figure to 4 decimal places. 4 decimal places. Are you getting that figure here? Are you getting that figure? Are you getting that figure? We try to be chap. Are you getting that? Are you getting that? I'm told by Patricia, yes. So let's go to year 2. We just need to change up our power to negative 2, which will give us 0.84, 8417. And then year 3, this will give us 0.7722. 7722. I hope those are the figures you are getting. I hope those are the figures you are getting. Okay. So if that is the case, then we need to get the present values. We need to get the present values by multiplying our cash flows with the present value interest factors. So in the first year, we have 60,000 times 0.9174. 9174. I'm getting 55,044. 044. So what about year 2? 60,000 times 8417. I'm getting 50,502. What about year 3? I have 1060 times what? Times 0.7722. 7722. I'm getting 818. 532. 532. Someone to confirm whether those figures are correct. Someone to confirm whether those figures are correct. Our figures correct here? Are the figures correct? Yes. So therefore, can we get now the total here? And basically the total figure which you're going to get here, that will be the liability component on this date. This will be our liability component of convertible loan note on 1st of January 2018. 1st January 2018. So get that total here. Okay, so I already have that figure from 9 what? 924,078. Someone to confirm whether this is correct. Patricia, Rogers, confirm whether this is correct. Confirm whether this is correct. Is this correct? Is that correct? Yes. So I'm told it's very correct. Okay. So then that is what we do in step 1, compute the liability component. Then we move to step 2. In step number 2, what we do is we compute the equity component. Equity component. We determine the equity component still on 1st of January 2018. 1st of January 2018. 1st of January 2018. So to determine this, the equity component, I've said we take the total proceeds. The total proceeds. So when talk about the total proceeds here, we are referring to the amount of money which was received by the company from the issue of these convertible loan notes. So if we go back to the information which we have in note number, not in note, but rather in paragraph 1, the paragraph 1, the first sentence, we are told, 𝗨𝗏𝘆 Limited issued 500 convertible loan notes, convertible loan notes on 1st January 2018 at par. At par. They were issued at par. So basically, we know that the company issued 500 convertible loan notes, and they were issued at a par value. We know the par value is 2,000 per loan note. Is 2,000. So meaning that the amount the company received here is 1 million. This is the total proceeds. This is the total proceeds, the total amount the company received. So to this total proceeds, we have said we then proceed and we less the liability component on the same date, the liability component on 1st January 2018, which we have computed here, 924,078. 924,078. 078. So that one we less it here. We less it, and basically whatever you get here is now the equity component. The equity component on 1st of January 2018. So someone to give me the equity component there. The equity component. How much is the equity component? Equity component, which is the difference between 1,000,000 and 924,078. Equity component, how much? I'm given here by Patricia 75, 922, 922, 922, 922. Someone to confirm whether that is correct. Someone to confirm whether this is correct. Is it correct? 75,922. Yes, I'm told is very much correct. So basically, in our case, we have not yet answered our question. We have not yet answered our question because if you check on what the examiner here was requiring, what was the candidate required to do? To prepare extract of a financial statement for these 3 years, 2018, 2019, and 2020. Financial statement extract for these 3 years. So remember I've said, in the financial statements, this company should account for a number of items. What you have said is that this value of equity component number 1, it will not change, but this liability component, because you have said it represents what the company has to pay for the next 3 years, is like a loan to the company. Is like a loan given to the company. So what we have to do, we have to amortize it. And in amortizing this liability, just like in amortizing a loan, we must have an interest component. That one will be recognized as an expense in the income statement. We will also have the liability balance. At the end of each year, it will be recognized in the statement of financial position as a non-current liability. So therefore, before we prepare those particular extracts, we have to amortize this particular liability for us to determine those 2 items to be recognized in the financial statement: interest expense, and number 2, the liability at the end of each year. So therefore, let's have that amortization schedule here. Amortization schedule. Amortization schedule. So how do we prepare this amortization? The same way you prepare their own amortization. So we have a column here for years. We will then have the other column here. Remember, if, for example, this was a loan, this would be the loan balance at the start, or the opening loan balance. This will be the balance brought down. Brought down, remember, is the opening balance. And then we have a column for interest. This particular interest we computed not based on the coupon interest rate, but you compute that based on the effective interest rate or the market interest rate, which you have used here for discounting, which is 9%. And then here we will have a column for the cash to be paid. In our case, we know the cash to be paid by our company in the next 3 years. Whatever you have here, this is what the company has to pay in year 1, year 2, year 3. That is what we will capture in this column here. And then finally, we have what? The liability at the end of the year, the liability balance carried down. That's basically how we arrange this schedule here. That is how we arrange that particular what? Schedule. We arrange that particular schedule. So if you go to the requirement, you'll be able to see that the first year ended on 31st of December 2018, 31st December 2019, 31st December 2020, 2020, like that. Yes, so have that schedule so that you can proceed. So let's prepare it. Let's prepare it. So we start with the liability at the start of year 1. Who can tell us now? I see whether we are together. What is the liability at the start of year 1? What is the liability at the start of year 1? What is the liability which we start with here? What is our liability at the start of year 1? The opening liability in year 1. Opening liability in year 1, how much is it? How much is that? How much is that? Give me the liability. Patricia, it can't be 60,000. It is not 60,000. It is not 60,000. It is not 60,000. What are we amortizing here? That is the first thing you need to ask yourself. What are we amortizing here? Ken, what is the liability at the start of year 1? What are we amortizing here? What are we amortizing here? We are amortizing this liability. This liability we are amortizing. So that will be the opening balance here. 924, 078, 078, 078. Then what we do next? We compute our interest, which we are saying is supposed to be recognized as an expense in the income statement. So this one, the interest will be 9% of the opening balance. 9% of that opening balance. 9% of 924, 078, 078. So confirm whether you're getting this figure here, 83,167, 83,167. Is that what you're getting as your interest there? As the interest, is this what you're getting as an interest? Ken, Patricia, Rogers, you need to talk to me. That's what you're getting? Yes. So then we need to have the cash to be paid. I've said the cash to be paid is what we have here. In year 1, company will pay 60, year 2, 60, year 3, 10, 60. So we can in fact have those figures here. 10, 60,000, 60,000, and 10 what? 60. So this is what the company will pay in year 1, 2, 3. That's yes. So how do we then get the liability at the end? Remember, this is like a loan. You had this loan at the start, you are charged that interest, but you paid that cash. So how do we get the loan balance at the end? We take your own balance at the start, we add the interest, we less what you paid. We less what you paid. Yes, that will give us now your own balance at the end. So we take the liability at the start, which is 924, 078, plus the interest, which is 83,167, minus what was paid. How much is it? 60,000. 60,000. So that will give us what? How much? It will give us 947, 245, 245, 245. Is that what you're getting? Is that what you're getting as the liability at the end of year one? Yes. So that liability at the end of year one now would be the opening balance in year two. It will be the opening balance here. So the opening balance here would be 947, 245, 245. So then we get the interest, 9% of this, 9% of this. 9% of that, which will give us 85, 252, 85, 252, 252. Yes. So your confirmation whether that is correct? Is that correct? Is that correct? I'm told yes. I'm not getting any answers from Kina Patricia, Kina Rogers. You need to be together by basically participating, telling me whether these figures are correct or not. Are these figures correct? Are these figures correct? Okay. So then can we get the liability at the end of year one? So the same, what we have done here. The liability at the start plus interest minus what was paid. Minus what was paid. Give me the liability at the end of year, at the end of 2019. The liability at the end of 2019, what are you getting? I'm given by Ken 952. 952, 497, 497. So someone may ask, why is the liability increasing? Because this is like a loan. Why is it increasing? We know that if you have a loan in a bank and you're repaying that loan, the loan should keep on reducing. But can you see your liability is reducing? Sorry, is increasing. Instead, it is increasing. Why is it increasing? It is increasing because much of this liability will be paid in year three. You can see the cash which the company will pay in year three. Much of that liability will be cleared in what? In year three. That's why you can see instead of reducing, because generally we know our own should keep on reducing, it is what? It is increasing. It is increasing. So this will be the opening balance here, 952, 479. So then we get the interest here, 9% of this. 9% of that. 9% of that. 9% of that.
I'm getting a different amount. I'm not sure whether.
Which one? That figure, the liability at the end.
Yeah, I'm getting 972.
972. Oh, 972. Okay. 972, 479. So this should be 7, eh?
Yes.
Okay, sawa. So then that then will be the opening balance here. And then how much is the interest for that year? The interest is how much? Interest for year three, how much is it? Yes, I'm waiting for the interest. I'm waiting for the interest. We need to be a little bit fast. Ken, Patricia, how much is the interest? 87, 525. 525. Then the cash which was paid during that year is that. So how much will be our liability at the end of year three? So what will be the liability here? I'm waiting for the liability at the end of year three. Ken Rogers, what is the liability at the end of year 3? Yes, so this one should be 0, but you may not exactly get 0 because of the rounding off, but essentially that should be what? Should be 0. So basically what we have done, we have amortized that particular liability. And having done so, now we can go ahead and we answer our question because we have not yet answered our question. So what the examiner was requiring there is the candidate to prepare financial statement extract. And in this case, I've said financial statement extract, we need to prepare the income statement extract. So basically extract is part of something because the income statement which you are preparing here is not a complete one. Basically does not contain all items of the income statement. So what we just need to show is what was supposed to be recorded or to appear in this income statement as far as these convertible loan stock are concerned. So therefore, we're going to prepare these for 3 years. So we need to have 3 years here, 2018, 31st December 2019, 31st of December 2020. And what I've said is that what the company should recognize in the income statement as far as this convertible loan stock are concerned is this interest. You see this interest here? This interest should be recognized as an expense in the income statement. This liability here will be recognized as a non-current liability in the statement of financial position. And also this particular equity component will be recognized as a component of equity in the statement of financial position, but in the income statement, only one item, this interest here. So the interest, in other terms, we refer to this as finance costs. We refer to this as finance cost. So the finance cost for the first year is 83,167, for year 2, 85,252, and for year 3 is 87,525. So this is what was required. You show that particular interest which was supposed to be recognized as an expense in the income statement for these 3 years. Then we prepare the statement of financial position extract. Statement of financial position what? Extract. Extract. Equally, we are preparing these. We need to prepare these for 3 years. 2018, 2019, 2019, and 2020. And 2020. So basically in this case, I've said we have 2 items which were supposed to be recognized here in the statement of financial position. First of all, we have this equity component, which will be recognized as a component of equity, and also we have this liability here. So, but basically what we know is that when preparing the statement of financial position, first of all, we record equity followed by liabilities. Equity followed by what? Liabilities. So we are saying this item here, we record it under equity. Specifically, we refer to it as equity component of convertible loan notes. Or this loan notes, or yes, convertible loan notes. Equity component of convertible loan notes. Make sure you write that in full. Convertible loan notes. And basically, this value here we said will not change. Over the period of 3 years, that one remain constant. That one will not change. It's not like the liabilities which we are amortizing, and as a result of that, it is changing. 75,922. 75,922. And then at the liabilities, or basically at the non-current liability, we record this liability component here. This liability component here. And actually, specifically, we refer to that as liability component of the convertible loan notes. Liability component of convertible loan notes. So this is the value of the liability at the end of year 1. So that's what we record here is the liability 947,245. The liability at the end of year 2 is 972,479. And at the end of year 3, it is what? It is 0. It is 0. It is 0. It is 0. So basically, also this what was required there. That's what was required. And basically, by doing that, then the marks allocated for that were 6. The marks allocated for doing that were 6 what? Were 6 marks. So that is it. Basically, once you come across a question and you're told a company had issued some convertible instruments, for example, convertible debentures, convertible own stock, convertible boats, and so on. So then what you should be able to remember very fast is that that is a compound financial instrument. And in accordance with IS 32, a company should split the 2 components of that compound financial instrument.